Hi guys, welcome to another video. On this video, I'll be talking about assets that you can invest in to protect yourself against inflation. So on this channel, we talk about personal finance, investing, and motivation. So in this video today, I'll be sharing with you those assets that you can invest in or you can own to hedge against inflation. We have started seeing the trend of inflation in the US and other parts of the world. For instance, in April 2021, the rate of inflation in the US was 4.2% compared to April 2020. So, and this have started happening in other parts of the world as well. For instance, also in Canada, this has been building up since last year when prices of commodities like lumber and other agricultural commodities have started increasing in prices, and this was as a result of some countries that are trying to buy a lot of some of these commodities for keep, especially the agricultural commodities. So, and this has started building up, and again, it's also interesting to see that interest rate are still at their lowest, and which gives business people or investors easy access to cheap funds. And at the same time, the pressure regarding COVID-19 has started easing, and people have started kind of spending, especially those people who have not been able to spend over the past 1 year and have been getting stimulus money from federal government, both in the US and in Canada and some of the developed countries as well. So this has led to more money in circulation right now, and then we started seeing the effect of inflation gradually. So in order for you not to lose for your investment or for your money not to lose value, you have to invest or own some assets that will protect you or that will hedge against inflation. As we know that a dollar today will not buy the same value of goods in 10 years, and this is due to inflation, because inflation measures the average price level of a basket of goods and services in an economy. It refers to a sustained increase in prices over a particular period of time, usually 12 months, and as a result, a specific amount of currency will be only able to buy less than before. The level of inflation in an economy changes depending on current events, for instance, such as rising wages, rapid increase in raw materials such as oil, and other factors are the major factors that kind of contribute to inflation. For instance, there are cases in the US where, or even in some part of Canada, where some people are still getting some of this stimulus package from the federal government, and as a result, they are not willing to work, and employers are willing to pay higher wages in order to get them engaged. So as a result of that, that's also like rising wages, and prices of raw materials like agricultural commodities especially, and even price of oil has started rising because of an increase in demand, because economies have started opening up right now. So as a result of that, we tend to see inflation, and then again the central banks are still holding interest rate at its lowest, and that may even be even till the end of this year. So in this situation, keeping your money in savings account, in bank account, is not the best option for you, because for instance, you only be given like 1% or 2%, and if you look at the rate at which the prices of goods and services have started increasing, or commodities have started increasing, some have increased about 10%, 5%. So, and then you're only getting just 1% on your money you're keeping in the bank. So that doesn't really make sense. So in this video, I'll be talking about assets that you can invest or own that will help you hedge against inflation. Inflation is a natural occurrence in the market economy, and there are many ways to hedge against inflation. A disciplined investor can plan for inflation by investing in asset classes that will outperform the market during inflationary climates. So keeping inflation edge asset classes on your watch list and striking them when you see inflation begins to take shape in a real organic growth economy. So this can help your portfolio to thrive when inflation hits. So let's go into those asset classes that will help you hedge against inflation when it hits. Gold has often been considered a hedge against inflation. In fact, many people have looked to gold as an alternative currency, particularly in countries where the native currency is losing value. This currency has failed. Gold is a real physical asset and tends to hold its value for most part. Inflation is caused by a rise in the price of goods and services. A rise in the price of goods and services is driven by supply and demand. A rise in demand can push prices higher, while a supply reduction can drive prices as well. Demand can also rise because consumers have more money to spend. However, gold is not a true perfect hedge against inflation. Gold is not a true perfect hedge against inflation. When inflation rises, central banks tend to increase interest rates as part of monetary policy. An asset like gold that pays no yield is not as valuable as holding onto an asset that does, particularly when rates are higher, meaning yields are higher. They are better assets to invest in when aiming to protect yourself against inflation. But like any strong portfolio, diversification is key, and if you are considering investing in gold, the SPDR Gold Shares ETF is a worthwhile consideration. The second asset I'll be talking about are commodities. Commodities are a broad category that include grains, precious metals, electricity, oil, beef, orange juice, and natural gas, as well as foreign currencies and certain other financial instruments. Commodities and inflation have a unique relationship where commodities are an indicator of inflation to come. As the prices of a commodity rises, so does the price of products that the commodity is used to produce. Fortunately, it's possible to broadly invest in commodities via exchange traded funds, ETFs. The iShares S&P GSCI Commodity Index Trust is a commodity ETF worth considering as well. So before investing in commodities, investors should be aware that they are highly volatile, and investor caution is advised in commodity trading. Because commodities are dependent on demand and supply factor, a slight change in supply due to geopolitical tensions or conflict can adversely affect the prices of commodities. Asset class is a 60-40 stock. A 60-40 stock bond portfolio is considered to be a safe, traditional mix of stocks and bonds in a conservative portfolio. If you don't want to do the work on your own and you are reluctant to pay an investment advisor to assemble such a portfolio, consider investing in Dimensional DFA Global Allocation 60-40 portfolio. The code is DGXIX. A 60-40 stock bond portfolio is a straightforward, easy investment strategy. But like all investment plans, it does have some advantages compared to an all equity portfolio. A 60-40 portfolio will underperform over a long term. Additionally, over very long period, a 60-40 portfolio may significantly underperform an all equity portfolio because of the effect of compounding interest. Keep in mind that a 60-40 portfolio will help you hedge against inflation and keep you safer, but you will likely be missing out on returns compared to a portfolio with a higher percentage of stocks. The next asset is REITs, Real Estate Investment Trusts. Real estate investment trusts are companies that own and operate income-producing real estate. Property prices and rental incomes tend to rise when inflation rises. However, A REIT consists of a pool of real estate that pays out dividends to its investors. If you see broad exposure to real estate to go along with a low expense ratio, consider a Vanguard Real Estate ETFs, that's VNQ. REITs also have some drawbacks, including their sensitivity to demand for other high yield assets. When interest rates rise, treasury securities generally become attractive. This can draw funds away from REITs and lower their share prices. REITs must also pay property taxes, which can make up as much as 25% of total operating expenses. If state or municipal authorities decide to increase property taxes to make up their budget shortfall, this will significantly reduce cash flow to shareholders. Finally, while REITs offer high yields, taxes are due on the dividends. The tax rates are typically higher than the 15% most dividends are currently taxed at because a high percentage of REIT dividends are considered ordinary income, which is usually taxed at a higher rate. The next asset class is S&P 500. Stock offers the most upside potential in the long term. In general, businesses that gain from inflation are those that require little capital, whereas businesses that are engaged in natural resources are inflation losers. Currently, the S&P 500 has a high concentration of technology businesses and communication services. They account for a 35% stake in the index. Both technology and communication services are capital-light businesses, so theoretically they should be inflation winners. Like any investment, there are disadvantages to investing in S&P 500 index. The drawback is that the index gives higher weight to companies with more market capitalization, so the stock prices for the largest companies have a much greater influence on the index than a company with a low market cap. And the S&P 500 does not provide any exposure to small cap companies, which historically produce high returns. And the next asset is real estate. This comes by investing in real estate and any income. So real estate income is income earned from renting out a property. Real estate works well with inflation. This is because as inflation rises, so do property values, and so does the amount a landlord can charge for rent. This results in the landlord earning a higher rental income. And there are pros and cons to investing in real estate. First, when purchasing real estate, the transaction costs are considerably higher as compared to purchasing shares of a stock. Secondly, real estate investments are illiquid, meaning that they can be quickly and easily sold without substantial loss in value. If you are purchasing a property, it requires management and maintenance fees, right? And the cost can add up quickly. And finally, real estate investing involves taking a great deal of financial and legal ability. The last one here is cryptocurrency. So in this case, I know most people are either familiar with Bitcoin. However, from my own perspective, I don't think Bitcoin in itself can be used as a hedge against inflation because it's highly volatile compared to some of these cryptocurrencies that are stable, called stable coins. So stable coins are a type of cryptocurrency whose market value is pegged to a value of a certain asset, popularly called stable coin. Cryptocurrency whose market value is pegged to the value of a certain asset. Popular stable coins include Binance USD, Tether, that's USDT, which are backed on a one-to-one ratio, which are backed on a one-to-one basis with the US dollar. This means that one BUSD or USDT is the same as $1. So risk-averse crypto users looking for a more stable store of value may choose to buy and hold stable coins over other types of cryptocurrencies. So when you're using cryptocurrency to hedge against inflation, you don't necessarily have to trade. So it's just converting your cash to that particular crypto for as long as possible. By using cryptocurrency as a hedge against inflation, or while using stable coins as a hedge against inflation, you don't have to trade. You are only converting your cash into a particular stable coin for as long as possible, and then you can convert it back to fiat. That's back to cash afterwards. So for most of the world's fiat currency are prone to inflation, as they are not backed by a physical good or commodity. Because fiat money can be issued by government and central banks, its value will slowly decrease over time as more money enters circulation. So, and that is what we see when there's inflation. The value of our currencies slowly decrease over time when more money are pumped into circulation. That means you can only buy fewer goods with the amount you have. So that means the value of the cash you have, the value of the money you have will reduce over time. So now, thinking about stable coins, why would stable coins serve as a hedge against inflation? It's important to recognize that not all fiat currency have the same price stability. Stronger fiat currencies like the US dollar or euro are generally more desirable due to their relatively low rate of inflation. To put it simply, countries with stable and growing economies often have more inflation-resistant fiat currency. However, many of the world's fiat currencies suffer from high rate of inflation, which makes these currencies a poor store of value. In some circumstances, hyperinflation or inflation that measures more than 50% per month may make it impossible for people to save or build wealth. People facing local currency inflation may find it difficult to exchange their money for a stronger fiat currency like the US dollar, for example. So that's where stable coins comes in. In many regions around the world, anyone with an internet connection can easily purchase stable coins to protect their wealth. So you can purchase stable coins like the BUSD and the USDT on Binance. Binance is the largest cryptocurrency exchange platform in the world. So in this video, I've been able to take you through why it is important to have assets that will hedge against inflation, and I've also taken you through those assets that you can invest in, and so that you can hedge or protect yourself against rising inflation. So the key takeaways, the key point in this video are: inflation occurs in market economies, but investors can plan for inflation by investing in asset classes that tend to outperform the market during inflationary climate. With any diversified portfolio, keeping inflation hedge asset classes on your watch list and then striking when you see inflation can help your portfolio thrive when inflation hits. Common anti-inflation assets like gold, commodities, and various real estate investment and tips. Many people have looked to gold as an alternative currency, particularly in countries where the native currency is losing its value. Also, commodities and inflation have a unique relationship, where commodities are an indicator of inflation. As the price of commodity rises, so does the price of the product that the commodity is used to produce. Thank you for watching. If you are new to this channel, please kindly subscribe to this channel, because I will be giving you content on personal finance and on business ideas, and also on motivation. So if you like this video, please smash the like button, share this video. It's gonna help the channel to grow. Thank you so much. I really appreciate your time. See you in the next one.